Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist, Phil Putney. Now let's get rolling with today's show. This week on Phil's Tax Hacks and Other Retirement Facts, Phil, a new proposal about Social Security changes. Anytime, look, something's going to have to happen.
Yeah,
and
we've been talking about it for years.
This is one proposal.
It's been on the horizon forever.
Yeah. And I want to stress, and I'll probably stress it multiple times when we chat about this, that this is not a law.
Yes.
This is just a proposal at this time. But
this isn't even in Congress yet. This is from the Committee for a Responsible Federal Budget. So.
That's hilarious right in itself, right? You know. But anyway, we're going to talk about this proposal because when people hear or see things like this, a lot of times there's a pretty stark reaction when they see a specific part, which is usually a decrease, right?
Right.
So let's dive into it. I'll do the setup since you kind of talked about it a little bit there. So yes, the Committee for a Responsible Federal Budget, which in and of itself is just hilarious. Because have they ever been responsible? But anyway.
They're not doing a good job, but that's
whatever committee, right? But they released a plan at the end of March, and we're into early April here, that would cap Social Security benefits at $100,000 annually for couples and $50,000 for individuals, starting at full retirement age, so 67, right? So the goal is to address the program's obviously insolvency, which now is 2032, they're claiming, not 2033 or 2034. They've moved it up another year.
Yep.
When an automatic 24% across the board cut would otherwise kick in absent of congressional action. The cap could save, this proposal could save 100 to 190 billion over a decade and close half of the program's insolvency gap, a 75-year insolvency gap. It only fixes half the problem. Right. So for context, right, Phil, also for the listeners, today's maximum individual benefit already exceeds that 50,000 cap at about 62. So meaning some people would feel a reduction. And when you hear that, people freak out and they say, wait a minute, I put my money into this, blah, 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 blah. So let's talk about who it affects, maybe who it doesn't affect, and just some pros and cons and what you think.
Yeah. So, I mean, it's one of the solutions that's being looked at. There's many out there. You know, we've talked about them before, changing full retirement age, uncapping the wage base for Social Security. So there's a lot of solutions. This is one of them.
Right.
And when somebody hears it at first, they're like, oh, wait a minute, $100,000 cap for a married, couple. Couple of things to keep in mind.
Okay.
Number one, I mean, that is at the full retirement benefit. So if you delay till age 70, you still get the extra 24%, so that really doesn't affect very many people as you start to look at it. And the other thing to consider too, is that this is the 50,000 individual, 100,000 for a married couple. Mm-hmm. They're not saying it's 50,000 per person, for instance, in a married couple. So that could be 50 or 100,000 for the married couple, but the one spouse was the high earning spouse. Mm-hmm. So they can have a significantly higher benefit than the 50,000. It's just the combined between the two of them can't exceed 100.
Can't exceed 100. And I was reading, Phil, that this really only may only affect about 30% of the population. The bottom 70, which is, let's be honest, the majority of America, correct, would probably not be affected by this, which is interesting.
Yeah. So, and I've got a graph that we can throw up here, but
Sure.
In this, they've done the study on it in this cap, this cap of the 50 and 100,000. They've looked at it a couple of different ways. Okay. One is saying, well, it's inflation adjusted. So every year that cap gets adjusted for inflation. Another way is to say it doesn't get adjusted for, 10 years, 20 years, or 30 years down the road. So it stays flat. And obviously if that cap stays flat for a more extended period of time, it's going to start to affect more people. And the amount of the effect is going to be broader. Okay. Just because your inflation still happens, right? So the chances of your Social Security benefit exceeding that, because it's increasing with cost of living each year, is going to be higher. So when we're looking at that, they're saying that that 70%, of the people, top 30%, think of it that way, that will be affected. If they did the inflation adjusted one, it wouldn't hit them. it doesn't affect that group until like the 2030, so the 30-year type of, or 2060, the 30-year non-inflation adjusted number.
Gotcha. Okay.
If it did, then for that group, it's like a 5% reduction. Who it looks at the top 1%, let's look at them. They're the ones that even if it's inflation adjusted every year, then they're going to see like a 5% reduction, they're saying, all the way up that if they do this flat level for 30 years to 2060 is the way they're looking at it. Because either way, they're doing a 5-year projection of flat and then indexing. So if they did that, this top 1% could lose as much as 25% of the benefit.
Right. So top 1% of earners in America, which
exactly.
And the argument becomes that they don't need it anyway.
Right. We're talking about a very small effect on the population. Now, granted, you can argue, is it fair or whatever? Right.
Technically they're allowed to have it just the same as anybody else, but yeah.
Right. But stepping back, looking at kind of the broad retirement community that's collecting Social Security, the vast majority of the people are never going to be affected by this. If it even comes into fruition.
Right.
This is just one simple proposal that is being put out there to say, hey, something to consider, right? For those top earners. And granted, they probably don't need it, the whole get into social justice thing. But taxes are the same way. They're paying a significantly higher tax rate than most. So, it's, this is just another form of, to me, taxation on that higher group of individuals by kind of means testing or limiting, what that Social Security benefit is.
Well, so, supporters of, frame the argument that Social Security shouldn't be sending out 6-figure checks to the wealthy, right? To the uber wealthy, I should say.
Right.
People have made jokes for years. Does Oprah really need, Social Security? No. Right. But again, what kind of compromises are made in that thing? But places like AARP, they're pushing back pretty hard, arguing that Social Security's identity, it's an earned benefit and it opens the door for more cuts later, which is definitely possible with government.
Right. Absolutely. And kind of going down that path, one of the other arguments in there is that, well, if you compare us to all the other developed countries in the world, we are more. Yeah. We are significantly more.
Significantly more. Yeah.
I got another chart that we can throw up that shows that, granted, the United States right now, it's like 93,000 is the maximum, so when you look at this, because everyone's always thought, well, is there a max on Social Security? Well, technically, no, but mathematically, yes, because there is a cap, right, every year of what the maximum earnings that you're contributing or paying into Social Security on.
Yeah.
So if somebody hit that max every year for 35 years.
Yeah.
There's mathematically a maximum Social Security benefit.
Yeah, so we're like in the 90s to your point, and I think like England's in the 30s or something. Yeah.
Right. Yeah, all the way down to like Australia is 30,975.
Yeah.
So it's a pretty
and we wonder why everybody wants to be on Social Security in this country, right?
Right. So, there's the other argument too. It's like, well, yeah, we've got this, much larger Social Security benefit that again, another argument with that is it was never intended to be something like this. It was really intended to be a benefit that was to prevent poverty in retirement.
Right. That was it. Right.
That's where it started. When it's morphed into something obviously much greater than that today. We're significantly higher than what a poverty level would be.
The Tax Smart Retiree is your comprehensive guide to mastering tax efficiency for a flourishing retirement. You will find indispensable advice and actionable strategies designed to enhance tax savings, maximize Social Security benefits, protect against market volatility, and develop a customized retirement plan. To get your free ebook, click the link in the show notes of today's episode and download your copy of the Tax Smart Retiree right now.
And we know that the numbers have changed drastically, right? It used to be like 20 people putting in for every one taken out. Right. Now it's like 3 to 1, about to be 2 to 1. So, there's things that are not sustainable. So I guess at the end of it, Phil, to wrap this up, what does it mean for, a potential retirement picture should this come to pass? And again, it's not passed. If you're a higher earner, then it may take a second look. You may need to look at things. I think for me, the takeaway, and again, we talked about this a couple weeks ago, the Secure Act changes 1 and 2, and just things in general. The writing is on the wall. It's being said, we need to say, like, future generations need to be prepared to fund their own old age better. And we have got to do a better job of forcing that, however that is, because that's how Social Security was started. You think about a lot of the programs now, if you don't opt out, you're automatically now put into a retirement account. Because they know that, unfortunately, a lot of people just will not. Because there's a lot of arguments right here on YouTube, Phil. For example, sorry, I'm getting off on a tangent, but there's a lot of arguments. People say, "Hey, why couldn't I just take the Social Security money that I've paid in for 40 years and used it myself? I would have done better, in the free market with that money myself." And you're probably right. The problem is that the majority of people, maybe not the majority, but a lot of people would not. They wouldn't save it. They would spend it.
Well, and it was never designed that way because the very first people that collected from Social Security didn't pay in or paid in very, very little.
And didn't live long.
Right, and didn't live long. So, it was always designed as the current workers are paying for those that are retired. It was never it was a pay-as-you-go, I call it, system. Right. It was never a private 401k or pension that you're funding for yourself.
But if you know that you've pumped $1 million into it over the course of your lifetime of earning years, it pisses you off. You want it back, and if you think that maybe I'm not going to get it back, that's not cool, right? So it's tough to it's a fine line with that social justice thing.
It is, absolutely, and I get all those arguments and I agree with them. But at the end of the day, you have to look at it too in kind of light of the bigger picture. Some of these other countries, Canada, for instance, Canada on their 44,000 is their maximum benefit.
Yeah,
but you compare what their tax rates are. Well, Social Security. Yeah, it's a benefit that you're paying into that you collect, but it's a tax, right? It's just another tax that we pay.
Right.
So
it's a much smaller tax than some of the socialist countries, right?
Than some of these other countries and the benefit that they get. So, something has to happen.
Sure, that we know.
This is one small piece of it that probably isn't going to affect, just even looking at the number here statistically, the vast majority of people.
Yeah.
A very small group of individuals that are going to be sacrificing for the
greater good, for lack of a better term.
Good, to help kind of prop up the system and make it work a little bit better. There's many other things that you're going to see. And this is hopefully just going to start to spur on more and more. It has to over the next few years, because we are running against the deadline of the trust fund running out, which at some point they're going to have to, something has to happen.
Yeah.
Right? And
that's a great point. And
I don't think, personally, I don't think that's going to happen. They wouldn't let that happen just because that's political suicide.
Yeah. Turn on the printing press. Right?
Yeah. You say, and unfortunately that's probably what's going to happen is they're going to, print a bunch of money to prop up the Social Security fund and buy it a little bit more time.
Yeah.
But that's not a long-term answer either. Something has to happen. This is one piece of it. Keep it on the horizon. Again, for most people, it's not going to affect you. Just think of it today, right? If you're in that position, what are your benefits today? And for a lot of people, you have been delaying it till age 70, let's say. So you've grown that benefit. So that's not 100, it's 124,000 now becomes your target.
Yeah.
So if your benefit's nowhere near that, then you don't have nothing to worry about under this proposal. Yeah. And again, it's a proposal.
It's a proposal,
It hasn't even made it to Congress of any kind of bill or anything.
Yeah.
We're a long ways from that.
And I think the big takeaway, if you hear things like this and you do get a little panicked by it, again, the vast majority probably wouldn't be affected. It would probably be the top. You can debate the fairness of that all day long. But I think the takeaway comes back to, what is your plan? What is your strategy? How much is Social Security actually impacting your lifestyle in retirement? For most people, we're trying to get a plan and we're trying to build a wealth and a nest egg and a legacy that it won't be a big deal no matter what government does. I think we all hopefully understand that a plan minus government somewhere is what we're trying to be after. If whatever they do, and if we get something, we're getting something great, right? But it's like at the end of the day, if you've got a good plan and strategy in place, Phil, where you don't have to stress about what they're doing, that's going to help you sleep a little bit better at night. You know, I know that's not something everybody can do, but I think that's the goal.
Yeah,
you know, because they're always going to tinker.
They're always, they don't leave anything alone.
Yeah, exactly.
And it's never simpler when they're done. So
no, of course not. Right. So anyway, that's the interesting debate this week on the podcast. As always, if you're concerned about your Social Security strategy or your lack thereof, or how it all plays within your overall plan, or the things that you've built for the last 30 or 40 years, and you don't have a cohesive strategy that you understand, or maybe you want a second opinion on one that you already got, reach out to a qualified professional like Phil. He's a CPA and a personal financial specialist, been helping families for many, many years. You can find all the links in the show descriptions down below. Get yourself some time onto the calendar, and don't forget to subscribe to us on Apple or Spotify or YouTube. Of course, he's in the Michigan area and serves folks all around, but he's got clients all over the country too. So if you need some help, reach out to him on the links below, and we will see you next time here on Phil's Tax Hacks and Other Retirement Facts. Hit that subscribe button. We'll catch you later.
Phil? Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.